Major funding for these programs is provided by HSH Nordbank and First American Title Insurance Company of New York, Perfect Building Maintenance, Allied Partners, Greenberg Traurig LP, the Moynihan Group. Additional funding is provided by Antares Real Estate, Arbor Realty Trust, C.B. Richard Ellis, City Habitats, Cushman & Wakefield, Essex Capital Partners, Fremont Investment and Loan, Massey Knackle Realty Services, Must Development LLC, Newmark Knight Frank, Palin Enterprises, Rosenthal & Rosenthal Inc., Signature Bank, Stonehenge Partners, Swig Equities, the Engel Berman Group, the Wickoff Group, Titan Capital, YL Real Estate Developers.
Welcome to the Stoller Report. My name is Michael Stoller. Everybody wants to own real estate, but when they buy real estate, they have to get the money to buy it. They need mortgages. They need financing. Now, sometimes they're banks. You hear about Chase, Citibank, Commerce, all of these. But there's a market of lenders out there who are unique lenders who provide money when you need it quickly, short term, and really are very unique type of people. Today, I'm fortunate to have 4 of those lenders to tell you about what's happening in the real estate market and how they lend in the New York and the greater New York area. My guests include Robert Famelin, Treasurer and CEO of Progressive Credit Union, Peter Rosenthal, President of Rosenthal & Rosenthal, Ira Saferstein, President of Titan Capital, and last but not least, Jeffrey Gould, President and CEO of BRT Realty Trust. So how do people find out about you? I mean, you're not native, you're not names over there in the newspaper. I mean, how do they find out of you? I mean, do they Google you? Do they follow up? I mean, what do they go to a taxi auction to find you? I mean, how do they learn about you guys?
Well, as a credit union, a membership organization, most of our members, I would say...
But I can be a member, even though I'm not a car.
Right, you can be a member. Most of our borrowers come to us through word of mouth. They know somebody who's borrowed from us in the past, they had a good experience, they recommend us, and they come to us looking for a loan.
Peter?
I would say most of our business probably comes from brokers, but also because of our presence in the broader financial world in terms of factoring and asset-based lending. We also get a lot of referrals from professionals, accountants.
Okay, Rosenthal's been around since 1938. So there's a number. I mean, Progressive's been around 75 years, originally up in the Bronx.
1918, actually.
Right. Ira?
I would agree. A good part of it is the mortgage brokerage community. It's word of mouth. It's the CPAs, attorneys, real estate attorneys, and that's...
We have a lot of repeat borrowers that come to us time and time again. So I'd say probably 50 to 60% of our business is from repeat borrowers who've had a good experience with us, and the remainder is typically from mortgage brokers, as the other guys discussed.
But, okay, so I want to buy my show airs in the greater New York area, East Hampton, Montauk, a lot of people watch it on the web. What type of deals do you do? Okay, people know about, here's a multi-family apartment house, here's, what type of unique deals, and how do you do these loans? Fam?
Well, we get some, what I would call accidental borrowers. These might be someone who have a business and all of a sudden they got an option to buy the property that their business was in, so they've gotten this option. They don't know what to do with it. They've never owned real estate before. They come to us because we had their business relationship and they ask for our help. That happens with car washes, that happens with laundromats, that happens with dry cleaners, those kinds of businesses.
So we're really talking about more of the owner-user?
Very much so. We deal with the owner-user.
We steer away from the owner-user.
Why do you steer away from the owner-user?
Well, we just feel more comfortable dealing with investment property, something that has a potential rental income stream, something like that. So we tend to steer away from that. Most of what we do is investment property.
I mean, very often people come to us because they need money fast. And the property may be bankable, but they need to close in 2 weeks, 3 weeks, and the banks can't move around that quickly.
As Ira said, most of our transactions, or many of our transactions, involve time-sensitive deals where a guy has to close literally in a few days because the bank financing fell out of bed, because an appraisal came in lower than the expectation of a bank, and for whatever reason they need money and need it real fast. So they can come to us. We don't ask for any third-party appraisals. We can underwrite property.
So wait, you'll do a loan without an appraisal?
We do it all internally, so it saves us the time.
We do that as well.
Same with us.
Yeah.
So you're
Independent appraiser.
yeah, but
Takes time. We're not as quick as they are.
Right.
Yeah, we've closed deals within 24 to 48
and
hours.
what are
if
the
need be.
size of the loans? I mean, are we talking about loans that are 200,000 to 20 million, or what's your sweet spot? What type of loans do you see?
Well, the largest real estate transaction that we've done is $4.5 million, but I would say our sweet spot is much closer to $1 million to $1.5 million.
And what type of transaction was this $4.5 million loan?
It was a diner and the property on 9th Avenue in Manhattan. The building was very valuable, it had valuable air rights, and there was a partnership dispute. And there was an auction, a court-ordered auction. One partner bought it from the other. We supported the partner who was the successful bidder, and we went to closing. A year later, they went and got more conventional financing and paid us off.
But isn't that the case, and then we'll talk about the other, isn't that the case in many of the loans that all of you guys do? Sometimes because of what Ira just said and Jeff said, for the expediency, people come to you and they may need it, and then eventually they'll have the conventional lender.
Absolutely. Many of these loans have a little bit of hair on. Besides the speed, they may also have a little bit of hair on it.
You mean like that yeshiva loan you did a couple years ago?
Exactly.
Tell me, I mean, that had a lot of hair.
That did have a lot of hair on it. This was a piece of property in Borough Park where the owner of the property had owned it for 30 years, a very valuable piece of property. He had a fight with the U.S. government. They had put an undefined lien on the property. It was impossible for him to clear title on the property, but the property was very valuable. And there's just no way a bank could touch it.
I mean, to answer your earlier question, we do primarily acquisition financing, rehab financing, renovation type loans. We'll finance property, garden apartments, for example, nationally that are have some issue or mismanagement previous to a new borrower coming in, buying a property, lower rent roll than the expectation will be, 6 months later. He'd rather come to us, bring up the cash flow on the property, and then refinance at a later date with a non-prepayable type situation with a conventional bank. So our deal size is anywhere from $1 million to $2 million upwards to $50, $60 million. Our average deal size is about $10 million today.
Ira?
Our sweet spot is about $5 to $10 million. We'll do deals as small
similar
as
to what Jeff just said?
Similar, yes, absolutely.
Peter?
We're probably a little smaller in size, probably 2 to 5 on average.
Well, the big thing is, it's like there was a movie a number of years ago, The Education of Dudley Kravitz, and they said, I want to buy land, okay? And people today, and I know it comes around, will you do a land loan? I mean, somebody sees, it's like the story of Sam Chang, who was on my show last week. He said he was going to Yonah Shimel Knish. He saw this property next to the Knish. It was a vacant lot, and it said a sign for sale, and he bought it. I mean, it was a vacant land. He was hoping to build a hotel. Would you do a land loan?
We would do a land loan, but I don't know if we would do that example. We'll look at deals maybe where plans are in place or they're close to being in place. We want to know our borrower's going to get in the ground, pretty quickly. We're not going to do a deal where they're going to bank the land or something like that.
Well, we looked at the liquidity of the property. And
land doesn't have too much liquidity.
People say, would you do a bowling alley? And would I do a bowling alley in Queens that can be converted to a CVS or Walgreens? Yes. Would I do a bowling alley in Syracuse? I wouldn't do anything in Syracuse.
Are you redlining Syracuse?
I am. I'm redlining upstate New York.
We're doing some land situations right now. Probably about 15 to 20% of our portfolio is in land. We're talking about infill locations that are, all the zoning is in place as of right. We're doing some deals here in New York City. The loan submissions have been unbelievable as far as land opportunity, although you have to obviously decipher which ones make any sense. But we're looking at a deal now on 44th Street. We're looking at some other transactions.
But as Peter said, he doesn't like, I think it was Ira who said, he doesn't like land loan, that doesn't have cash flow, which land doesn't have cash flow. How do you make the determination of how much you should lend on that type of thing?
Well,
I mean, my viewer's here, he found this property. And
yeah, I mean, we're like I said, you look at the FAR, you look at the amount of dollars you're in for per foot on the land alone, and then you figure out the construction cost of what you may or may not build at that time, which is, you may want to build condo, you may build hotel. I mean, obviously here in New York City, there's an extended stay and other opportunities. and just figuring out the costs and where you're at, both initially and then with some, typical what we'll do is we'll lend on the acquisition of the land and then just provide some soft costs until such time as they can get a construction letter to take us out.
I mean, so on a land loan, since there's no cash flow, do you, and this is a question for land loan, for other type of loans, for all of you, will you escrow the interest for the person because there's no cash flow coming in, and you hope one way or the other the guy has to pay you off?
Typically, we would, I mean, if we need to, we'll escrow for interest, but a lot of times what we'll do is we'll have the borrower continue to show an investment in the property by putting up some, if not all, of the interest carry on a monthly basis. So although there's no cash flow coming in, we want to make sure that the borrowing entity still has the wherewithal, going into the deal and carrying through the deal. So we hope to get some cash coming from them on a monthly basis.
We'll lend a few monthly payments. We're doing a deal now, the renovation of a building in Upper Manhattan. It's going to take 3 months before they're rented. So we're giving them the first 3 months of payments. We're adding it to the loan. And by day 120, we would expect that they'll be fully rented, they'll have their cash flow in place, and they'll be able to resume the payments on their own.
I mean, for us, a lot of what we're doing now is not only land acquisition, but also construction. We'll do the whole thing. So a lot of times we do have to build the interest in on that. Obviously the borrower wants to pay that out of proceeds. But
we talk about construction. Jeffrey brings it up on land and construction. You talk about Ira with this. There's a lot of construction. Is there too much construction taking place in New York City today from the venue that you see? I mean, Williamsburg, for example, Greenpoint. Everybody thinks that they find a 20-foot piece of property, they can build a condo. Pick up the New York Times. The only guys who are earning anything today is the Times on their advertising because they're getting all these ads. I mean, what's your opinion of all these new condos as lenders?
Well, I mean, New York is like no other market. We're a national lender, and I could tell you when everything else is having trouble or going down over the last few years or last few months specifically, New York continued to move in the positive direction. I don't think that there's the hotel market, there's an industry that's in need of additional units, extended stay additional units, the condo, and I think there may be a slight oversupply of condo, but yet you don't see prices dropping too much. And maybe they're on the market for a little bit longer than previously, but it seems to be relatively strong.
But we were saying before, and Ira brought it out, that Connecticut, FAMI has a deal that's being in foreclosure, and the Connecticut market is not that way, right?
We don't have the concentration of wealth like you have in New York. I mean, it's just, prices are still rising here in New York. You can't compare this market to Miami. You go down to Miami and in the Brickell area, they were going to build 100 skyscraper condos, and maybe there's 5 or 6 going up. Half of them have fallen through the wayside. But is New York overbuilt? It really depends on the area. I mean, there's certain areas way out in Brooklyn that
I'd like
to,
for example, my show next week, I'm going to be talking about development in downtown Brooklyn. Now, there's a lot of development taking place in downtown Brooklyn. I mean, the question is, will it be absorbed? Perhaps, 5,000 units could be absorbed. It's a question of time when it can be absorbed. I mean, people come to you for the Bronx. What's your opinion of lending in the Bronx today?
Very, very strong. I mean, the Bronx has totally improved, versus 20 years ago. I mean, we have lent to a lot of builders up in the Bronx, 2 to 4 family construction, and houses get sold as soon as they're complete.
Peter?
Well, in that area in particular, I think 2 to 4 family, that type of thing, we've been doing a lot of that because I think our feeling is obviously it's a lot easier to absorb something like that, and there's also rental possibilities, investment possibilities with that. We're always looking for some type of backup plan. Most of the projects that we get involved with are not 30, 40, 50 unit condos. They're usually smaller.
If you lend properly, a backup plan will work fine. I think that, that's the key is not to overlend, whether it's a big condo or a little condo. You want to make sure that there is the capacity to rent if you can't sell, or to be able to sell to somebody else who might have another use for the property. If you haven't overlent, a lender will be safe. If you have overlent, you're in jeopardy.
Right.
We see a lot of opportunity in the Bronx as far as conversion of existing property to an alternative use. A lot of industrial building conversions to retail, a lot of, obviously the apartment rental going to condo. We've been seeing a lot of that type of business of late.
You're Long Island based, your headquarters is in Long Island. What's your opinion of Nassau and Suffolk County today, the real estate market out there?
It's been very strong. I mean, the office market's been great because the spillover of the high rents that you're seeing here in the city. The residential market still remains strong. There's definitely product available, but yet things are pretty positive in the Nassau market for
Do
sure.
you see anything?
You know, we do a lot of construction loans down in the Hamptons, and it's just extremely strong. In fact, we have a loan on a very high-end house that we just heard got on a contract today for $17 million. No problem. It's on the market for about 2
But
months.
that's interesting. So here's somebody. You have a $17 million construction.
I don't. I have actually a much lower loan, but the property, my loan is $6 million, but the property.
But how much was the cost of the land?
About $4.5–5 million.
So that's the comment that I think,
Very high-end piece of property.
No, but
Right
I
under
think
water.
what they're saying is that the high-end property in the Hamptons is moving.
It
The
is.
middle range properties, the 2 to 3 are hurting.
That's what's-
Okay, that's where
That's
it
what
is.
I've heard. I actually don't know if that's true or not.
I mean, I'd actually read recently that prices were down in a lot of parts of Suffolk County
Yeah.
past year, so I don't know.
I'll give you
I mean, we don't do a
an
lot
area
out there,
which
but-
I'd be very cautious on, and I know this specifically because I had them on my show a couple of years ago, is these active adult communities in Nassau and Suffolk are hurting. WCI's property in Sunrise Highway near West Hampton, it's 4 years old, it's 70% sold, and they can't get rid of a unit. Pulte's property in West Hampton is having major difficulties. So that was a market that really everybody thought. Now I think there's one in Westbury that Beechwood Benjamin is building, but there are different products. I think what Ira is saying is a fact that luxury market is really there.
Very hot.
Right, the mid-market, that we've seen that to slack a little bit, but I mean, like I said earlier, the New York market, is unlike others. So it's really both, I think, all the way out to the East End.
Right.
What about, a lot of my viewers, a lot of my people, people consider Jersey City the sixth borough. I mean, don't ask Josh Musk. Josh Musk doesn't believe that. But, because of the convenience, because of the fact that you can take the ferry, not the water taxi, wrong place, Fire Island. I mean, you can do that. Have you seen opportunities in lending into both Jersey City and Hoboken?
We've been in both areas. Jersey City, we made a land loan some time ago. We're taking out about a few months ago on a major development there, so there's definitely development opportunity there. Hoboken we've been into as well. There's new areas of Hoboken actually that have emerged. We actually have been seeing, we saw a deal recently in Elizabeth, New Jersey, which has not really grown like the other areas that they're considering a major development on as well. So there's some definite opportunity, or at least perceived opportunity by our borrowers in those areas.
Sure. We lend in Hoboken, but we don't lend in Jersey City. Just haven't liked that market.
Really? Well, and your reason?
Just historically, we've never, just didn't like the market, the liquidity of the market.
Interesting. Yeah, we have a few loans in Hoboken now. I don't think we have anything in Jersey City, but my sense is there's probably more opportunity there right now than in Hoboken.
Robert?
We did a laundry in Hoboken, and then the owner of the laundry bought the building, and he's doing great.
Hoboken's a great town.
Hoboken's a great.
We're talking about the Hamptons. And there's a lot of in New Jersey. There is Long Branch, which has really seen a resurrection over there, and Asbury Park. Do you see that market? I mean, that part of Jersey. I mean, and that's a strange market because it's like a seasonal market.
Well, we actually made the loan on Asbury Park that you're speaking of. That's a major development that's going on. They're going to resurrect that whole area. So there was an assemblage of maybe 60, 80 different properties that were kind of put together through tax foreclosures and everything else, where a particular borrower has really put together a massive piece there, and they're doing some incredible stuff. So Asbury's going to come back. We were involved in it early on in the process when they were just assembling the land. But there's some major activity going on there.
We were bidding for a project in Asbury Park, and we were not familiar with it. We were a little tentative. We priced it high, and by the time the negotiations were over, they were able to get significantly better financing from someone else and left us.
Ira?
We don't lend down in southern New Jersey, and if we have to take back a property or we have to foreclose on a property, I want to make sure there's plenty of people that want to buy that property instead of me buying it and having to deal with it. And I just don't find the liquidity is too high there compared to the New York market, the Miami market, and some of the other areas that we lend in.
You know, Robert
A lot of
spoke
that's hospitality down there.
No. You know, it's interesting. Somebody came to us for a hospitality loan in Wildwood, and I said, you know, I'm not certain I like the Wildwood area right now for a seasonal period of time. You know, I don't
And not
think
to
they're
say that Jeff didn't make a great loan there. I mean, there are always good opportunities.
No, I think he has great. I
We've
think-
been in and out, so it was good.
Yeah, he knows the market a little bit better. And you know, the key thing in this business is not to overlend, as you said.
Right, but you know what Jeff said is, you know, and what I've seen in New York is hospitality is hot as hell. Have you lent to hospitality, or are you?
Sure.
Okay, because you know, in a way, it's like Robert's clients. It's an operating business, and you have to, you know, that's the big difference of an operating business.
Who's the operator?
That's
Which is the
exactly
key.
right. Now, my question is, and I think Fahmy brought it out, but what's the profile of the type of borrower who comes to you? I mean, you explained that situation in Borough Park. That was a different type of borrower. But traditionally, what type? You know, are they real estate investors, or are they people who may have had that opportunity to get a piece of real estate and they need something? I mean, or are they both?
We're finding primarily they're real estate opportunity people, but you'd be surprised with the high net worth of many of our borrowers. I mean, you know, we go from situations where they're high net worth guys that are just buying property and growing their net worth by a situation where they come into a property, complete a property, fix it up, and then sell, down to situations that are more in need of money because they're coming out of a foreclosure, or there's an interesting opportunity through a bankruptcy. But most of our businesses with pretty high quality borrowers, but we'll look at this.
Higher?
Well, I think if you looked at this business 10 years ago, it was very much a story loan business where two partners were fighting, or you know, they needed the money fast, they hated each other at this point. There's always a lot of hair on the properties, but with the increasing pricing and the liquidity of money, a lot of these situations are gone. I don't see that many story loans anymore. It's more of speed of execution. It doesn't have as much hair as it used to have. And as Jeff said, that we have very, very high net worth individuals that come to borrow from us, and they need the money fast. They may take us out shortly with a more bankable, you know, a bank loan or other sorts of financing.
Yeah, I mean, guys don't mind paying. Even the high net worth guys don't necessarily mind paying if there's. We don't charge any prepayment penalties whatsoever. So a guy gets done, takes us out.
Yep.
Could be 3 or 4 weeks later. If we provide the access for them to buy the property that they're going to make a lot of money on, they don't mind paying the freight. And high net worth guys would rather do that than tie up their
The
dollars.
same with us. We had somebody come to us recently. I mean, guy was bankable, but he said, I don't want to wait 3 or 4 months to get in the ground. I want to get in the ground now. I'll pay you the extra couple of points. It's worth it for me to get the project started. I can build in 6, 7 months, move on to the next project, and you know,
Robert?
that's what we look for.
As you know, we lend a lot of money in the taxi industry, and many of our real estate deals are people who started off as taxi drivers, became taxi owners, successful taxi owners, multiple taxi owners, and now they're parlaying their equity in the medallions into real estate. So our borrower is primarily someone who was not born here and is looking to the American dream of owning real estate.
You know, and the classic line about private lenders, we're cheaper than a partner. You may pay up a little bit.
You know, I was about to say that.
You may pay up,
No,
but
no.
not that much. All 4 of us here are not very expensive
You
private
know,
lenders.
You know,
We're not-
it's very interesting. Somebody was saying, you know, I go to my shop, you know, and we become your equity partner. It's better to be a mezz lender from us because at least we don't own the deal. You know, it's a question of what the freight is, and I think the fact that you do provide a service because you're providing the swiftness, and in many cases, you know, what I heard Robert say, you know, he'll sometimes lend up to 90%.
That's correct. But his line is a terrific line that I often use. When people come asking for more than we can give, I'll suggest to them what you really want is a partner, because we're not going to share their appreciation, so we shouldn't share too much of the risk, just an appropriate risk as a lender.
But a partner you have forever on that property.
Mm-hmm.
The private lender you have for 6 months to a year to get your house in order a little bit.
So, I mean, in today's market, you know, Ira said he hates anything upstate New York. Is there any type of lending that you hate in the greater New York area that you don't like? I mean, is there anything
we
specifically that you guys don't like?
We stay away from specialized situations. Assisted living is typically not something we do. Hotel is typically not something we do. We may finance the land acquisition, but anything that's an operating business, where it's not really a real estate business where you can. We're comfortable lending on anything we're willing to take back. That's our philosophy. Anything, not that we want to own it. We want to lend on it and get our money back, but if for some reason...
So we would say in the proverbial
it's not
way,
a loan to own.
Oh, it's not a loan
not
to
a loan to own.
Not a loan.
But if we have to own the property, we're comfortable taking it back.
You wouldn't mind
on
owning. Okay, got
No,
it.
and you know, you get into situations that are operating businesses like a hotel, and that becomes much more difficult.
Ira?
I agree with Jeff completely. And there are certain things in New York we won't do, industrial, assisted living. But again, you have to look at the bottom line. After you vet out the people you're lending to, ultimately your recourse is to the property. And you have to feel that you're going to be comfortable owning that property if you take it back.
We take
Knowing you?
We take the same approach. We don't want to finance, we don't want to operate a business. So we tend to avoid things like hotels and things of that nature. In the rest of our portfolio, we finance businesses. In real estate...
You know, another adage is, you know, loans go bad, we don't want to make bad loans. You never want to look at that file after it's not performing and say, how did I do this? What was I thinking? But we stay away from vacant land. We don't do vacant land at all.
You know, we're in the... I hate to say when I was in your business as a lender in a similar manner, but we didn't call it this. We called it hard money in certain other terms. We're in a great real estate cycle. Cycles don't last forever. Do you see the market in the, and you said upstate New York, do you see the market in the New York area changing? Do you see there's going to be some, you know, potential difficulties out there? Because, you know, the capital markets, as we know, the securitization has really had an effect. But do you see anything happening?
In the local market, it looks to be still pretty promising. I mean, I've been told over the years from generations that it's a 7-year cycle up and then 7 years down. This has been a 13 or 14-year cycle, I think, of positive. So you would think that there would be a correction of sorts, but yet at this point, we're not really seeing it here locally. Obviously, there's a big correction going on nationally. Ira mentioned Miami. Miami's a bloodbath right now. It's a specific area, so I guess it just depends on the markets.
Yeah, it's like the person who came to me about 2 weeks ago. Great site in Bow Harbor. I said, good, own it to yourself.
We have 2 loans in Miami where people bought pre-construction, fully planned on selling them. We're not able to sell them. They have deep pockets. They've closed. They own them, and they're on the hook for them.
Yeah, I think we're a little bit concerned, a little cautious. You know, we're just wondering whether we're going to see a spillover from some of the other markets. I mean, I think if the overall economy were to take a real dip, you know, have a recession, I would think there'd be some impact here, but we haven't really seen it yet. We're just waiting for it, you know. But
and the sources of capital to you haven't really tightened anything. I mean, because you have line banks, you have line banks, you have line banks,
yeah.
And you have the credit union.
Right.
So you haven't seen
plenty of capital available.
Okay, there's plenty of capital available. So I think, you know, in a way, of all my shows, I've never had the type of guys like you to really profile what's happening and a source, and I think that my viewers and other people should know that there are 4 great people over here who can provide different types of financing. I'd like to thank Robert Famelint, Treasurer and CEO of Progressive Credit Union, Peter Rosenthal, President of Rosenthal & Rosenthal, Ira Saferstein, President of Titan Capital, and last but not least, Jeffrey Gould, President and CEO of BRT Realty Trust. Next week, we go to downtown Brooklyn and what's happening in downtown Brooklyn. See you next week. Thank you.
Major funding for these programs is provided by HSH Nordbank and First American Title Insurance Company of New York, Perfect Building Maintenance, Allied Partners, Greenberg Traurig LP, the Moynihan Group. Additional funding is provided by Antares Real Estate, Arbor Realty Trust, C.B. Richard Ellis, City Habitats, Cushman & Wakefield, Essex Capital Partners, Fremont Investment and Loan, Massey Knackle Realty Services, Musk Development LLC, Newmark Knight Frank, Palin Enterprises, Rosenthal & Rosenthal Inc., Signature Bank, Stonehenge Partners, Swig Equities, the Engel Berman Group, the Wickoff Group, Titan Capital, YL Real Estate Developers.